Hi everyone, we had the case study on Pensacola Surgery Center's time value analysis. Question 1 says to consider the $50,000 excess cash and assume that Gary invests this in a 1-year CD. So part A asks us what the CD's value at maturity will be if it pays 10% annual interest. What I've done is at the bottom is show you the Excel syntax for how to plug this into Excel. So we use the future value function, and we start with the rate, which is 10%, but you enter it as a decimal, so 0.10. Our time is 1 because it's annual, and our present value is 50,000. Make sure when you're doing this function that you make the present value a negative because that will give you a positive answer. So if it pays 10% annual interest, then our future value will be $55,000. Part B asks us to say, what about if it paid 5% interest, and what about if it paid 15% interest? So what we do is we change the interest. So this time instead of 0.1, we do 0.05 or 0.15 for 15. So the future value, if our CD pays 5% interest, will be $52,500. And if it pays 15 interest, the future value would be $57,500. Question 2 asks us to rework parts A and B of question 1, assuming that each CD has a 5-year maturity. So we still use the future value function in Excel, but this time instead of changing the rate, we're changing the time, or the NPER as is known in the formula. So if we pay 10% annual interest with a CD that has a 5-year maturity, our future value will be $80,525.50. Part 2B asks us, what about if it pays 5% interest and 15% interest again? So if we have 5% interest with a CD with a 5-year maturity, our future value will be $63,814.08. If it's 15% interest, our future value is $100,567.86. Question 3. Now consider the surgery center's goal of having $200,000 available in 5 years to buy a new patient billing system. Part A asks us what lump sum must be invested today in a CD paying 10% annual interest to accumulate the needed $200,000. So for this problem, we use Excel's present value function because we're trying to figure out what we need to pay today to be able to reach our goal in the future of this $200,000. So we plug in those numbers for the present value function, and we learned that our lump sum will need to be $124,184.26. Part B, what annual interest rate is needed to produce $200,000 after 5 years if only $100,000 is invested? This time, since we're looking for rate, we will use the rate function in Excel. So if we hope to produce $200,000 after 5 years with $100,000 invested, then we need to find a rate of 14.87%. Question 4. Now consider a second alternative for accumulating funds to buy the new billing system. In lieu of a lump sum investment, assume that 5 annual payments at $32,000 are made at the end of each year. So remember, an annuity is a series of payments made at equal intervals. The annuity they are describing is an ordinary annuity. An ordinary annuity is defined as an annuity with payments occurring at the end of each period. And as seen in our question above, we are making payments at the end of each year. So these are equal intervals, and because it's at the end of each year, it's an ordinary annuity. For Part B, asks us what is the present value of this annuity if the opportunity cost rate is 10% annually and 10% semi-annually. So with this one, we're back to present value. So we plug in our numbers again, and if we plug those in, we find out that the present value of our annuity is $121,305.18. And then what changes in the opportunity cost when the opportunity cost rate is semi-annual is that we now need to calculate the EAR, and we actually use that for the rate instead of the other. So if we use EAR as our rate, then we should get back that our present value would be $120,534.40. So remember that the reason we use the EAR instead is because it's multiple payments of an annuity. It's split up, so if it's split up and not ordinary anymore, we need to have the rate adjusted a little bit. So we need to use the EAR for this situation. For Part C, what is the future value of this annuity if the payments are invested in an account that pays 10% interest annually and 10% compounded semi-annually? So we are back to using the future value function in Excel. So we plug our numbers in, and because this one is just 1 year, it's just annually, we use the given interest of 10%. So this means our future value would be $195,363.20. And now that we move over, and if we're looking at 10% semi-annually, we need to change and use the EAR, the adjusted rate, instead of the given rate. So when we do that, we use the 10.25%, and our future value comes out as $196,337.83. For Part D, what annual interest rate is required to accumulate the $200,000 needed to make the purchase, assuming a $32,000 annual payment? We're going to use Excel's rate function again. So we plug our numbers in, and we are told that to accomplish this, we need to have a rate of 11.18%. For Part E, what size annual payment is needed to accumulate $200,000 under annual compounding at a 10% interest rate? So this time we're looking for annual payments, so we are going to use Excel's payment function. We can plug our numbers in there, and it tells us that to accumulate that $200,000 at a compounding 10% interest rate, then our payments need to be $32,759.50. Question 6. Now consider the uneven cash flow stream stemming from the lease agreement given in the case. Part A. what is the present value of the annual lease cash flow in the if the opportunity cost rate is 10% annually. So for this problem, we're looking at net present value. So this picture we have here, this is what it would look like similar to Excel with these different cells filled in. And then with Excel, you'd use the NPV function. The NPV function is a little different. It'll have you enter the rate and then two values. The first value needs to be your range of the years. So it needs to include years 1 through 5, and then you add on the extra of year 0. And if you plug those into NPV, you will end up getting $47,328.61. 6. Part C. Does the office renovation and subsequent lease agreement appear to be a good investment for the company? So when we look at this, we learn the present value less the cost of the renovation ends up being $7,328.61. This means that yes, it would be a good investment because even after paying everything we owe, we will be making a profit. Question 7 asks, what amount of interest and principal will be repaid at the end of each year of the loan? So this is similar to an amortization table or schedule. And what we need to do is, at year 0, we're starting with this $200,000. So we start with $200,000 as our beginning amount, and then we give a payment of $63,094.16, which gets us to our principal and our interest, and comes back with our remaining balance. And our remaining balance then becomes our beginning amount for year 2, etc. So when you're solving these, you can use the payment function in Excel, and that will help set up your table so that you're getting the right numbers for each column and each period. So when you get this all set up, if you haven't reached 0 by the end, then something's gone wrong. Because this is showing us the amount at the end of each year until it's paid off. And in the question too, it specifically says that we're having equal annual payments. So that's why on our graph and in our calculations, the payment is the same throughout all the columns because they're equal payments as we were told. We hope this helped, and please feel free to message any of us or comment and let us know if we can explain anything better or help you out, and we are very willing to do that. Thank you.